What's up, everyone? Welcome to the daily macro update for Tuesday, October 28th. We have some pretty interesting macro data here today, with really the big story being that the stock market is completely ignoring what the bond market is signaling, which is a growth and inflation slowdown. And so, what the market is trying to do right now is get ahead of this slowdown with anticipating rate cuts and potentially a flood of activity for stimulating the economy with those rate cuts. Now, the only problem is that when looking at those types of dynamics in the past and previous market cycles, we've seen that that initial phase typically is not able to have a rally initially, and you have a little bit of a sell-off in the markets. And so, this typically happens near market tops, but, we're not here to time or call market tops at all. We just want to make sure that when they do happen, we recognize them. And so that's what's important about looking at this macro data, is that when there is a dip, you know the difference between if it's a dip to buy or if it's a dip to raise the red flags and get the heck out of the way. And so that's really what this channel is about and what we will be looking at here today. So let's go ahead and get right into the macro data here. We saw that the ADP employment report that looks at private jobs, they're doing this once a week new jobs print with the absence of the regular jobs numbers coming out next week for the month of October due to the government shutdown. It showed that there was 32,000 jobs lost in the month of September, which is a pretty high number. I think that's the largest one. I think that's the largest drop in private employment from ADP in a long time here. So while I'm actually live here on the live stream here, let me go ahead and just take a look at the Fred data for this. So bear with me if it allows me to bring it up here. Let's see if it did update today. No, it didn't update. So interesting. Yeah, so this is a pretty large decline here. And so, we'll continue to track this, but apparently they're going to be coming out with this estimate each week as an update, which is pretty interesting, I would say. But yeah, private job growth is not looking too great. And, the massive amount of numbers are coming from the trades as well as professional business services. As well as leisure and hospitality, all things that typically don't do very well when the market is contracting, right? And so that, along with some of the other macro data that we have here today, with services in the Richmond Fed area showing a stagnation. We also saw the Dallas Fed Business Index contract for the second month in a row. And then the 5th District Manufacturing Index also slowed down. So you're seeing, as well as U.S. home prices year over year also had a decline. So, with a lot of the optimism that's currently in the stock market right now, we're seeing the exact opposite in the real data, as well as what the bond market is signaling. And so taking a look at some of these metrics on the charts here, you can see that pretty much the Dallas Fed Manufacturing Index remains in contractionary territory. The Case-Shiller Home Price Index is at its lowest level at, let's see if we go back to the max here. It's been declining, and it's at the lowest since July of 2023. This is the home price index from the Federal Housing Finance Agency. And let's see if we go back all the way to the max. Yeah, this is at its lowest point, 2.3%. It hasn't been that low since April of 2012. So that's a pretty large decline. What else here? Richmond Fed Manufacturing has had a little bit of an improvement, but still remains in contraction. And then the Richmond Fed Service Revenues Index, which has had a bounce from the May 2025 lows from negative 11 points to plus 4 points. So that's a little bit of a positive rate of change, but still remains in contractionary territory. And, when taking a look at the bond markets right now, we can see a flattening of the United States yield curve. So when looking at this right here, this is the United States yield curve going all the way back to March of this year. And, really, as you can see, some of these more shorter term moves, if I go back on the 100-day time frame, one second here. Let me put this on 100 just to give you a better sense of some of these longer term moves here. You can see that pretty much since April of this year, right? So April 20th, the yield curve has been just going sideways, right? It really hasn't had any type of real steepening that's been able to last. And so typically, when the market is doing this type of flattening, specifically a bull flattening, which is when the long end of the curve drops lower or at a faster pace than the short end of the curve, that is typically signaling a slowing economy, right? And so the real data and the bond market are pretty much saying the same thing. It's the reason why the 10-year is performing. It's the reason why the 10-year yield is in a bearish trend right now. And I think what the market is typically showing here is that this slowdown is something that isn't going to happen once we get some relief from tariffs. And the only problem is that if they do ease up on tariffs and the market continues to slow down, that could be a pretty large headwind on the market itself. And so when taking a look at the flattening yield curve, the 10-year bond yield declining, while at the same time you have the S&P 500 breaking way up to new all-time highs, you have to make sure that you're taking a look at what volume is doing at the same time, right? Now, on a 1-month time frame, volume has been steadily increasing, but as you can see, if you zoom in on this bounce that we're having in the S&P 500, you can see right here that it is on decelerating volume, which is typically a bearish divergence, which doesn't mean that you go bearish on the market. That just means whenever you see a bearish divergence, that's typically a great time to take some profits in order to then raise cash to buy in lower. And so that's really what we're seeing here, right? We have the real economy and the bond market signaling that the economy is slowing down a lot. And then on the contrary, you have the S&P 500 and equity markets trying to front run that weakness because of Fed rate cuts and the liquidity aspect that happens with that. And I think this optimism is on weaker volume. And so it's great, if you guys were buying, some of the dip over the past couple of weeks, but this couldn't be a better time to risk manage and sell a little bit into that strength in order for you to buy lower once volume comes back in. And so that's what my team and I are looking at here. And we continue to see things like gold have a correction. My team just started over the past 24 hours to start adding very small and incrementally back to gold. We haven't looked at silver, gold, or silver, gold miners, or silver miners for that matter. But it is interesting to see that there. One of the big ratios that I like to take a look at is the gold versus S&P 500 ratio. And that gives you a real sense of what the stock market is doing in real terms. And so, if you zoom out here, as you can see, ever since the start of 2025, the stock market, the S&P 500, in terms of gold, has been in a huge crash mode bear market. And what we're seeing right now is simply an aggressive bounce from the hard crash that's been going on ever since August 18th. And so, this still remains in a bearish trend despite this very aggressive rebound that we're seeing right now in the S&P versus gold ratio. And we're really not seeing any changes in the macro dynamics because it keeps flipping between weakening economy and stagflationary. And so I think that um, the sentiment with this rate cut and soft landing optimism might be short lived just by looking at the volume aspect of it and the divergence there. But yeah, it couldn't be a better time to take a little bit of profit with things making new all time highs like NVIDIA, Broadcom, some of these other big names, big Mag 7 names, all of which are in bullish trend except for Amazon as well as Meta. So a lot of big Mag 7 stocks are reporting tomorrow as well as Thursday. And then, of course, we also have the Fed meeting coming up tomorrow starting at 2:30 p.m. Eastern Time. We're going to be going live on this channel at 2:15 p.m., so 15 minutes before Jerome Powell goes live for the press conference. And that's also 15 minutes after they released the press release for their Fed decision, for their rate decision. And at the timing of this recording, 24 hours from now, there is a 97.8% chance that they're going to cut by 25 basis points. And so that's pretty accurate. Usually the CME Group's FedWatch tool is pretty accurate, you know, within 2 weeks leading up to the actual meeting here. And so, yeah, it's pretty much already baked into the market that they're going to cut by 25 basis points. And really, that hasn't been the real big driver of these Fed meetings. It's really the press conference afterward and what Jerome Powell guides to with their future actions. And so at the timing of this recording as well, what the futures market is pricing in is that they're going to cut by 25 basis points tomorrow and then 2 more times after that, once in the December meeting and then the 3rd time in the January meeting. And then after that, they're going to remain paused until they cut again by 25 basis points in June of 2026. And that's currently what's happening. You know, that could change based off of the deteriorating real economy. So we still have to pay attention to that. But one thing's for sure is that more rate cuts are coming. And yeah, as of right now, the market, the stock market, the equity markets are currently viewing that as a positive development. So we got to make sure that we are looking at what the market looks at and not what we want to look at. But that's pretty much all I have for you guys here today in terms of the macro update. And so what we'll do is we'll get into some questions here. I do have another meeting coming up in about 10 minutes here, so we got to make this a little bit shorter, but I want to make sure to answer any one of your questions, and then we can go from there. The worst performing asset so far has been this large correction in real estate, XLRE, and then we have utilities, a decent correction there towards the low end of the trading range. Not quite there yet. And then the best performer has been tech. How's everyone doing today? Got a couple questions here on YouTube. Matthew Wright says, if natural gas is currently in the November contract trading at $3.30, how do you play that? Which natural gas are you talking about? Which ETF? And I don't necessarily trade options that fast, so I'm probably not the best help with that. What are your thoughts on the beverage curve? I know what you're talking about. I don't have it up currently, but yeah, we can get into that possibly tomorrow. A follow-up to my question, are you are you patient? What indicators are you paying attention to help navigate the situation? Matthew, I'm not sure what you mean by are you patient? So if you could re-ask that question, that'd be great. What ticker / stock do you use to buy gold usually? The ticker GLD is what my team and I prefer, only because it's the gold ETF that has the largest assets under management. So this one right here. Let's go ahead and get into some of the questions here from TikTok. Appreciate the shares and the likes. Is it too late to start adding more stocks or wait for a correction? It depends on which stocks you're talking about, you know. Do you mean tech stocks? Do you mean utility stocks? Like, what do you mean? Will energy rebound once the Mag 7 reports? Who knows? You're asking me to make predictions. What's your outlook on spot gold right now? Would you say that this is a correction or gold may have lost momentum given that lower CPI wasn't able to reignite the bulls? Gold is still in a bullish trend, but it has lost a significant amount of strength. And so my team and I, with it, being at the low end of the trading range right here, you want to be a little bit slower to, just be going all into something like this. Because again, you have to incorporate volatility. And, when taking a look at gold volatility, yes, that has come down a lot. But when taking a look at the average for gold vol, you can see that it's still pretty elevated right now. If you could construct a macro optics ETF, how would you structure it? Well, if you're in our macro investing community, you know exactly how we'll structure it. Matthew Chow says, is Berkshire bearish in your model? Yes, it is. Hello, are you positioned in the Asian stocks? Well, the best performer right now is Vietnam, so that would be the only thing that I'd be owning currently. Do you invest in any individual Canadian stocks or just broad ETF? Just the broad ETF. There aren't any Canadian stocks that I'm looking at currently. Can we all access the yield curve you showed earlier? That is for Partnership Circle members, but I do showcase it on here. Good questions. But yeah, I mean, so the Fed's probably going to cut tomorrow, and then we'll see what the guidance is on the press conference there, and that's what we will cover tomorrow. But all right, it's 4:10. I do have to get to my next meeting here, and I appreciate everyone for joining. Good luck out there, and we will catch you in tomorrow's daily macro update. Remember, starting at 2:15 p.m., 15 minutes before the press conference starts with Jerome Powell. Bye, everyone.